Hey everyone, hopefully you're having a good day. My name's Andy, the channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through together, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive in, take a look, see what's going on today. If you want to follow me at Finance, and if you want to join our community, finding-value.com, I dive deeper into these topics, subjects, looking for investment opportunities, and sharing those opportunities with everyone in the community. I do that through midweek updates and through Q&A sessions on the weekend, where I interact with the community through those Q&A Zoom calls that are recorded and uploaded to the website. We have a special coupon code that's going on. It is $25 for the first month, and the first month only on a monthly membership for that discount. The yearly membership is $100 off, and you can swap from a monthly to a yearly if you'd like to do that. Elliott Wave International, stocks are dangerously overvalued. So it says, of course, when I click it, it goes there, but normal stock market valuations are down here in that little rectangle area there. 2024, you are here up there in the S&P Industrials price to book value ratio. Look at how distorted the market is on that particular valuation. On the opposite end of the spectrum, oil is the cheapest it's ever been. So we've got oil on one end, and the price to book value ratio of this up here. What do you think I'm going to buy? Guys, this is a lot of people. What they tell me is, you got to wait for a breakout. You got to wait for this. You got to wait for that. And it's all price movement based. Focus on valuation. Focus on valuation. Use your technicals for your entry points. Use your valuation as your protection. It keeps you in cycle, and something like this keeps you out of it. I don't want to be here. I don't want to be in the S&P Industrials price to book value of this over 7. I'm not touching that. It's dangerous. 2021's right here too. 21, 23, 24, this is getting up there. Now, can it go up more? It could. Not saying it can't, but I'm looking for protection. So let's say you blow a technical entry. I can hedge myself with time because I have value on my side. You know, keep these things in the forefront as you look at these charts and as you think and synthesize what I'm saying and try to put it to use, to apply it to the markets. Here's one from Rock Bottom. Corn is launching off one of the biggest bases you'll ever see. A 51-year volume shelf. There's a lot of trading that's occurred there. Not just a rally, a paradigm shift in the making. What is corn a representation? You know when corn goes up a lot? Oil goes up with corn, and so does natural gas and fertilizers. They all go up together. So you have to kind of add these charts up. Every chart that you see should be a piece of the puzzle. Corn on a 51-year base looking like it wants to launch higher. Stack that in the back of the brain. We'll pull it out as we look at other charts. What benefits when corn goes up or wheat goes up or soybeans goes up? Generally, fertilizers do. Do fertilizers outperform in bull markets? They do. They do. Coming down, when is it going to be energy's turn? So this is energy versus the S&P 500. Remember when I was talking about those valuations just a few slides above us? We know the S&P is very expensive. XLE, I know he's got this zoomed in. This is only 2020 here. We're really zoomed in here. So XLE against the S&P, XLE is cheap, SPY is expensive. And this is the bottoming pattern in my opinion. It bottomed here in a shoulder, head, shoulder. We broke out, and then we're going to get a flag pattern retest, which it's doing right now. This is about to go at any second. Now, when I mean by any second, that doesn't mean that it's next week. What I mean is over the next, say, months or years, this is going to break out and it's going to go. And it could break at any second. So that's what I mean by any second. It doesn't mean that I believe that it will happen tomorrow. What I mean is it could happen at any time between now and, let's say, 6 months to a year. You can see the RSI is strengthening, and those are all positive developments. We've got a nice shoulder, head, shoulder, bottom, the breakout, and then the retest to the support zone, which is right where we're at. This could break at any time. We're just waiting for it. Patiently, obviously. Posted this inflation versus deflation index chart in linked post below, saying it was a false breakdown. It was, now breaking upwards. Getting ready for a second inflationary wave is now imperative. Commodities are looking good for another big move from gradient. And this is the inflation index versus the deflation index. So there we are in the 8-year price range. We have a nice little falling wedge and a breakout to the upside. Now, this doesn't mean we will go straight up necessarily. It could. But, I always prepare myself for things that aren't like straight lines. Things move in waves. They come up, they go 2 steps up, 1 step back, or 3 steps up and a step or 2 back, depending on where you're at in the cycle. You kind of have to get used to that rhythm. So like when we break something, it's like you get this maybe surge higher, and then you get a pullback. And then you get another surge higher, and then you get a pullback. Like right now, we had a massive surge higher in gold. Silver junior mining companies, they had that huge surge out of that pattern. You got to prepare yourself for a couple steps back. It's like the market breathing and, inhaling and exhaling. When it inhales, it's that big surge on up, and then it exhales and blows out spent air or energy, and then it comes and pulls on back. So here we are breaking out, and I think we're going to see an inflationary cycle. So and that's what all the charts are suggesting, guys. They're all suggesting that. Even the valuations. Remember, keep these charts in the back of your head. The first thing I showed was the S&P 500 valuation. Do you know how it got up there? That valuation, this declining is how it got up in that valuation. The market conditions of a disinflation or deflation environment or market condition pulling this down against inflation for all those years from 2009 till 2025, I guess, on this. That's how those valuations are so distorted. It was from the market condition. It's from this chart that we're looking at and the way that it was pulling down here. Now, if we move on up, I think that those valuations will reverse. And it's linked. These are all linked. This is linked to this, which is linked to corn, which is linked to these valuations. That's how I view the market. They're all linked and interconnected. So every chart we look at, there's a connection piece to all the others. And the connection is the market condition, money or inflation, and interest rates. Those are the main drivers of the market condition. And then all of these are pieces of evidence of those conditions. Why do Bloomberg and the EIA hate oil so much? Follow the money. I can tell you why they hate it. Because Bessent and Trump want lower oil prices. And I'm sure Bloomberg, Bessent, and Trump are all interconnected somehow, is my guess. That would be my guess. We've seen some pretty weird articles, but maybe they're not. Maybe by weird happenstance they're not, and they just get bearish when other people are bearish and bullish when other people get bullish. That's another potential outcome. What I do is I let the charts speak to me. Let the charts speak to you, add them all up, and then tell me what they say. All of these charts that we are showing you showing that inflation is coming. We've got a shoulder, head, shoulder bottoming pattern. Maybe I can pull this up. One second. Let me shift this over a little bit. That's the chart looking at it from an entire, the entire big picture view. The last commodity bull market its bottom was down here. We came up in a flag pattern, broke that, had a little consolidation here, broke that. Ultimate peak. There's your topping pattern that will draw in front of you. The big, nasty upward facing candle, upward facing. Oh, crap, I drew that one bad. These are all kind of upward facing continuation patterns. This is the bottom here. That's a shoulder, a head, and a shoulder. And then this is a retest of this break there. And then this is going to break higher. Could happen at any time. Don't know the exact time frame. There's your trend line that you want to break. And that's it. That's your XLE versus SPY. Your bull market is this. Your cycle up, your cycle down is all the way here, and then your cycle up is coming into play here of a double bottom. Could we head a little bit lower down here? We could. That is totally possible. I'm not saying it can't do that, but it could happen. I'd say probably over the next year or so, we'll see a bottom here and a turn. So that's what I see in the chart there. That's how I quickly drew it and what I'm seeing from the cycle perspective. Coming down, we've got Gary Baum. He says, it appears we are at the point in the current sell-off in miners that is creating a once-in-a-cycle opportunity to accumulate shares of hyper-profitable, cash-generating companies at prices that assume gold will never recover. Yeah, but that also happened with oil, didn't it? Oil was super risky in 2020. The equities were. They rode up a pretty big move in oil. They deleveraged the balance sheets. They look really good right now. And I think oil is going to start heading higher, probably against gold too, but I think oil is going to start heading higher. Think about the opportunities there. And I think gold's just going to be in the same situation that oil was a few years ago. So gold maybe we chop sideways for a little bit and let the fundamentals and the pricing kind of all catch up to each other. People will get more bearish as gold companies delever if they have any debt, buy back shares, do all this stuff, just like the oil companies are doing. And then they'll just take turns going up, back and forth. They'll just take turns. Here's aluminum. Start strong. Look at that. Nice little breakout there. We were so on top of aluminum. We had such good entry points back here even. We were looking at a couple companies that they're up a couple bagger already. With this breakout, I think it's going to continue. They're just going to keep going up. Just going to keep going up. They're better entry points than aluminum right now, I think, in iron ore and some other areas. I think there's some real good entry points right this second. Like, I would not be waiting. Here's Grady again. It says, could see a continued pullback here in the miners, the gold and silver miners, but do not lose sight of the very big picture. Gold miners are bottoming on a very big picture versus gold. It means gold miners will outperform gold in the long term. The ratio now has a breakout above that small purple line. And this means that the next phase in the miners bull is soon starting. That is a 9-year base. The bigger the base, the higher in space. Huge gains the last few years, which will continue big picture-wise. So a lot of people, what happens is a lot of us who do this kind of like longer, bigger picture charting, we get incredibly bullish at lows. And people will, the day-to-day movements will grind people down. They'll get frustrated. They're not able to hold. And I think what we both do, at least I can talk for myself, but we look at these big pictures, like this big falling wedge and a bottom here, and that's where we gain our bullishness and our confidence, our conviction. It's from the big picture charting. And then we can see it in all these other charts. It's not just XAU versus gold. It's the TSX Venture breaking out. It's inflation versus deflation, which I showed you above. It's the valuations of commodities and the valuations of the S&P industrials that I showed you at that first one. These are all parts of a cycle, a big cycle. And on the big long-term cycle where the big money is made, they're all bottoming in commodities and precious metals. And conversely, they're all topping or will be topping and probably chopping sideways for 10 or 15 years in equities like the S&P 500 and NASDAQ. So I've been in this commodities thing since 2020. I will probably be here for a while. And the hardest thing for most people to do is just wait and sit. They see the market moving in front of their face. They get worried when the price goes down. They get excited when the price goes up. And I feel those emotions too. But I suppress my emotions. I control them. I look at these big picture charts and say, you know what? That's what's coming. And that's what I hold for. I hold for the big picture, the big move. I think they're all going to move up. They may not all move up at the same exact moment. So I'm diversified across, and if a portion of the portfolio rips while other ones chop sideways or consolidate, I'm okay with that. I've got exposure to the upside in each of these sectors. XAU, which is the gold and silver mining companies, I've got exposure. I've got exposure to, rare earths and iron ore and oil and natural gas. And, a lot of people, what they try to do is they try to trade this market. They trade it. They want to, let's put all my money in uranium. And then let's say it's not doing something very quickly. They get scared if it goes down or it goes the opposite direction. So then they sell out and they chase something else. And what I found is that you just kind of run around chasing all these different sectors, not making much money. You're not capturing those upside gains because it's frustrating and it's stressful when you have all your money subjected to only one sector, and it doesn't work out. So what I've done is I say, okay, well, I don't have to put all my money in one sector. How much money can I put into one sector that will change my life? Then I try to get that amount of money in there. And then I put it in each sector. How much money should I deploy where it'll change my life? Bam, 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 bam. Maybe it's 5 sectors, 7 sectors, 10 sectors, or 10 different ideas. And then you've got companies within all those ideas. And then you just let it go. You let it go. And you know what I've learned from the greats? I'll tell you what I've learned. I've learned from the greats that you don't want to trade in and out. You want to stay for the big picture. You want to stay for the big, long move. And what else I've learned is that they've made almost all of their money on very few stocks. And they've made all that money on very few stocks because they held for a very long time. They never sell. So I'm not saying that we will never sell. But what I'm saying is your holding period for most people is far too short. You're not letting the markets play out. Your time frame is too short for this big pattern to play out. I mean, this is coming down. This is the early 90s here in this falling wedge. This is going to be a gigantic bull market that will probably last many years. The Latin American MSCI index is breaking out, driven by what I believe to be the ideal combination of depressed PE ratios and accelerating economic growth. While all eyes are on Argentina today, we're witnessing a broader region-wide transformational shift. The political environment is arguably improving, but more importantly, there's growing awareness of Latin America's strategic importance to the U.S. and other Western economies. The region is a vital supplier of the critical natural resources needed to support commodity-intensive initiatives such as reshoring, manufacturing, modernizing electrical grids, building data centers, advancing automation, and AI, strengthening defense capabilities, and driving electrification. Exciting times likely ahead for this region in his view, and we have a Latin America just breakout here of the index. We have exposure to it. I have exposure to it. I think this is going to be huge. Why? Because I think their currencies are going to outperform the United States dollar, and we're going to see money flows go into it. This year is one of the biggest opportunities in the market for regular equities, not commodities, but regular equities. It's a way to diversify and not be 100% in commodities. You can go into some of these emerging market countries. Their currencies are going to outperform. We're going to see a big move in some of them. coming up here. Here's Grady talking oil. I love oil, guys. Been saying for years that we will see at least $250 to $300 oil during this bull market. Been posting that orange back test for oil will most probably hold. It still is. Oil is shaping up here. The red bullish falling wedge now looks good. Get ready for the second inflationary phase to start soon. This commodities bull market is the best opportunity you will have in life to get out of the rat race. When that second pink head and shoulders broke down, I understand that blue head and shoulders probably was going to play out, and it very much did. This is the kind of guidance, yeah. So we're ready to go here, I think. We're at the low end here, and I think we'll probably break out at some point. Some point. This is a huge opportunity here. And we're going 250, 300 plus in oil. Totally agree. Coming down, here's COPX. Copper miners are gearing up for a generational breakout. We're at the last key resistance, ready to break out here. Volume is stepping in. See the volume on the right-hand side? Looks fantastic. We're going to get a big breakout. That's copper. Copper. Is a rotation happening? Gold moves first, copper follows, oil moves last. Copper's ready to break out. Oil's about to set up here and move up with copper eventually. So yes, we are set up for that, and everything looks a-okay for launching. The first rule of fishing is fish where the fish are. And the second rule of fishing is don't forget rule number 1. And in investing, it's the same thing. Fish where the value opportunities are located. That's where you want to be fishing. Avoid anything that's of bad value. That's what I'll say there. And that's what I've got for today. Just to give you guys one heads up on the website. I mean, just to give you guys an example. Recently, one of the examples. So this would be a chart setup that I'd be looking at. Very large, big move last bull market. In terms of percentage terms, if we were to start the bull market of where we're at, so I'm starting the chart right there in the beginning. This did a 37 times from the corner of this here. So the corner of this to the peak is about a 37x. We have a very similar setup today. If you guys notice, we purchased it on the website to give you guys an example. In this corner here, we were adding into it, and it recently broke out on some earnings releases of this particular setup. So just to give you guys an idea of what I do on the website is I go around and I look at these charts. I look for these big fractal sizings with a large up move, previous bull markets. I look for companies that haven't done a lot of dilution. There are certain sectors that don't dilute very much. Some of them, their share count has gone down. This was last bull market, so the bottom of the bull market was here. It came up, came back. This is kind of, we'll call it wave 2 almost. And then we had a gigantic surge higher here in that. Well, actually, yeah. I think we have a very similar setup right here today. And we've entered some of these companies. I'm just showing you one in that area right in the corner there. And we're breaking out. Things look very good for this. Now, this is where we were getting all jiggy with it in here, in those areas there. So that's kind of what to expect. That's what I've been doing. I'm not going to share the company here, but these are some of the things that I look at for people on the website, and I share this, and I take entries alongside of you guys. Right in the corner here, just like me, we all, those who wanted to get into it, got into it, I think, and that was just giving an example here, so you guys have an idea of what I'm looking at. There are other examples, just to like pull up another one that's maybe a little bit more, I'll call it ripe for an entry. Let me see if I can find it here real quick for you guys. So here would be another example. You're underneath kind of a resistance area. What happens is you break out of it, which we did. Then you get a return move, and then your return moves brings you back here, and then this would be a good entry point in this area down here for an entry. And I'm just giving you guys like examples on the website. If you guys, this area would be a real good one. This breakout here would be a good one for entries that I look for, to give you an example. And then we ride them all the way up for these cycles. So that's just to give you guys an example of the website. And these are non-correlated stocks. I look for these big, basing patterns that you break out of, then you get a retest. A lot of the super junior companies are doing this too. And then we get in there and ride the bull, ride the bull. So just want to show that for the heck of it. But that's all I've got for today. Give me a thumb up for the content. Subscribe to the channel if you'd like. And that's all we got. So we'll catch you next time. See ya.